Hello and welcome to another episode of Darwin Investors. Man, we got another big week on tap here, folks. We got the midterm elections, which are coming out this week, which has historically been a pretty nice catalyst for the markets. And more important for the markets, we've got the inflation data that's going to be coming out on the 10th. Now, when we look back at last week, we had the FOMC meeting, which left a lot of us scratching our heads because a lot of us, definitely myself included, kind of felt that with the obvious softening of the economy, we might be getting a softening of the tone of the Fed's rhetoric with respect to interest rate hikes. But man, we didn't get that at all. Instead, what we got was confirmation that the Fed was committed to driving up the unemployment rate and plunging us into a nasty recession, something that they like to code as some pain, as a way to strengthen the economy. You
cannot be serious!
Well, what do you do? Well, what I did was I went out and I got some lottery tickets. And so I got these things here, and I got, let's see, the top is the NASDAQ, and then the S&P 500, and then the Dow Jones. And then right here, these numbers, this would be the Russell, and then this would be the VIX, and that was kind of a short number followed by the 10-year bond yield. And so we'll see what happens. And yesterday I was out doing yard work. Are you happy, pal? I'm doing my own lawn care now, okay? Are you happy? So I was out doing my own lawn work, and a couple of guys are going by, and we were talking about the lottery and what would we do if we won the lottery. And I know what I do. If you see that I'm suddenly making more videos and I'm broadcasting from a castle that I've turned into a brewery, I might have won the lottery. I'm not going to tell everybody, but what I told those guys in the streets was that if you're at the checkout aisle and you suddenly see that I'm declared the sexiest man alive, I might have bought People magazine. But what I really wanted to tell them was that I would just not spend a nickel of it. Instead, I would invest it all into JEPI, because this is what would happen. Because if you look at JEPI, it's trading right now for $53.80 a share. If you got to figure that after taxes, you might end up with, say, $1 billion, right? And now JEPI pays a monthly dividend. Last month, it was 61 cents a share. So if all you did was take your $1 billion, divide it by $53.80, you'd have 18,587,000 shares of JEPI, and you multiply that by 61 cents. That means last month, JEPI would have paid you over $11 million, and you'd still have all your money. And that's what I do with my lottery winnings. All right, enough of this jibber jabber. Now, before we get into the meat of this video, first, I got to give you a word from my sponsor. Guys, have you ever felt that driving up the unemployment rate and causing a nasty recession is the way to actually strengthen the economy? Well, if you have, you've probably been drinking a little bit too much of my sponsor this week, which is beer. Maybe I'll also create a windfall tax on oil companies as a way to drive down gas prices too. Yeah. Now this week's beer is actually a really hard one to find. I thought I couldn't believe it. It's pretty local, so it's Yingling, and they put Hershey's chocolate in it. And I'm not gonna lie, it's got a very good flavor. As a matter of fact, it's the way Papa likes it. Oh yeah, And after having tasted this beer, I feel that I have no choice but to reward this beer with 5 Kate Rooneys out of 5. Now let's go ahead and get into this. So the U.S. added 261,000 jobs in October, and that did not make the Fed very happy. They're looking for something closer to zero. But when we look at this chart, it doesn't tell the whole story. So the 261,000 jobs has actually been coming down month over month. And the 261,000 is actually the smallest number on this chart, dating all the way back to January of 2021. The second smallest number being here in April of 2021 at 263,000 jobs. When we look at the unemployment rate, we're currently sitting at 3.7%. We can see that it kind of bounces between 3.5 and 3.7. If we look here pre-pandemic, we can see that it also bounces between 3.5 and 3.7. But for whatever reason, now they don't like it. Then it was fine, now it's bad. And this doesn't tell the whole story because the employment in the leisure and hospitality sector still remain 1.1 million jobs below the pre-pandemic level. Which leads us to this chart right here that shows that since January 2021, Leisure and hospitality, which only makes up 11% of the economy, has added 3.1 million jobs. And every other sector has only added 6.8 million jobs, which means that 11% of the economy has added 35% of the jobs, and we're still 1.1 million jobs below the pre-pandemic levels, which is why we're getting things like this. Like we're looking on the same page and we're seeing that payroll surged by 261,000 and the unemployment rate is going down. However, we got stuff like Elon Musk and other tech companies saying that we're going to have big layoffs. This reminds me like of back in 2000 when I was working in computer programming. We had what was called fire drills, and it's different from a fire drill. Like a fire drill is when you come to work, you pack up your crap, you turn in your badge, and you leave the building. You've just been fired, and you just do it as a drill to just kind of practice. And that's kind of what's happening right now in all these tech companies, and nobody seems to care about them. They're saying, well, they can go off and get other jobs, but that is not true. People that were getting these jobs were not going off into hospitality and leisure. They were trying to find other tech jobs, and they just weren't there. Now, next, I've got this interview with Citibank's chief economist, and it's coming from Bloomberg TV, and I believe it's the best forecasting I've seen from 2023 based on the data compiled by Citibank. And he outlines it and kind of gives it to you in a way that's very easy to understand. I love this video. Let's check it out.
So what is the trend then on non-farm payrolls if you're going to have a 2 million job loss? I mean, do you get down to whatever the run rate is, 100, 150? Or are you suggesting a stream of negative statistics?
I think the negative statistics are next year. This is very unfortunate. Policy lags, the way they work. The simplest way to illustrate this is to think about the housing sector, where I can give you the simplest way of looking at it. If you think about what's happened to total construction spending or unfinished housing, it's fallen 2%. Sales have fallen 35%. Because the problem is it takes 6 to 12 months to plan a construction project and deliver it. So what is being delivered now is coming from a time when we had a much lower mortgage rate and a much higher sales pace. Next year, the people who are working on building those houses don't have a new house to build, and they're going to have job losses. And it's going to be extended not just in housing, but in marketing, sales, trade, finance positions. So many things that have happened with over $150 billion buildup in real business inventories this year. So you're just taking a look at the economy that on the production side is catching up, but the demand side is heading lower because of policy. Now, the Federal Reserve recognized it in their statement, but we just have to realize here, higher unemployment is U.S. public policy.
And I love that video. Now, 2 million job losses might sound like a lot, but that's what happens when you create policy based on lagging indicators like housing and unemployment in a quickly changing economic environment, rather than trying to use leading indicators like the earnings guidance that we've been getting, or maybe some of these layoff forecasts that we've been getting. Now, I love this example of housing sector, but we've seen this in other sectors. We've seen it in, say, microchips. I mean, I'm old enough to remember when we had a chip shortage. I'm old enough to remember when we had a supply chain problem. Now we've gone from a chip shortage to a chip glut. And we've gone from having a supply chain problem to companies like Walmart and Target and Nike having like so much inventory that they can't get rid of it all. And things are just happening so fast right now. It's how that analyst from Citibank could come out and say that we are going to have like 2 million job losses next year, as crazy as that sounds, because he believes, and I believe as well, that the unemployment rate can change just as fast as the chips and the supply chain changed. And that's why that analyst from Citibank thought that maybe we could lose 2 million jobs next year, because there's a thought out there, and I believe it to be true, that the unemployment rate could change just like the chip sector and the supply chain problem. And that unemployment rate could balloon in a big, fast hurry. So the midterm elections are going to be happening this week, and in all honesty, I don't care who wins. I don't really have a dog in this fight, but it is shown that the most important thing for the market is to know that the election is over. Now, the market seems to have a favorite. It says if the results are not clear but not heavily disputed, and China is opening up after COVID, The market sentiment is quite overwhelming in our view, such that there's likely to be a bigger rally if the Republicans win. So, I think that that's who is supposed to win in this election coming up. It seems like the Republicans have a little bit of a tailwind, which is to be expected right now, given that we have a Democrat president. That's just kind of the way things work. And I like this article showing that over half of Americans believe that both Democrats and Republicans do such a poor job that a third major party is needed. You can count me in the over half of Americans. I'm very cynical with respect to politics right now. I think it's all about clicks and money. And I would be all for a neutral party that kind of takes the best elements of both and kind of uses common sense to and push agendas forward that kind of benefit the most people. But right now, it all seems to be about, you got to create fear and anger. Fear and anger creates clicks. Clicks creates views. Views creates advertising. Advertising creates money. And money is kind of what this is all about. And so I'm just kind of disenchanted right now. I wouldn't mind a third party that's very neutral, but neutrality doesn't get much in the way of clicks. So I don't see that happening anytime soon. So I'm just have to hold my nose and vote for somebody. All right. So also coming up this week is going to be the inflation. The CPI data is coming out. Right, last month it was at 8.2%. It was thought that it was going to be 8.1%. The consensus is coming down to 8. If it goes to 7.9%, and I knew that today, I don't know which direction this market would go in. Would it go up? Might they say, well, that's way down from 8.2%, or would they say 7.9% is still high and send it down? That means the Fed's still going to have to tighten even more. Nobody really knows what this data even means anymore. At least I don't. I suspect it's going to be somewhere in the 8 to 8.1 range. These guys, they tend to be off, but they don't tend to be off by a whole lot. We'll see what happens. Now, something that's been coming up is that we've been hearing that the oil trade is like the new FAANG. Is Exxon the new FAANG? Well, I don't know. I tend to think that FAANG now is the new Exxon. And what do I mean by that? Well, I used to be like, beating the drum back in, say, April or May of 2020 to go out and buy oil because oil was so cheap. And this is when I was first getting into it. You can see the number of shares is pretty small. And so this would be like April, May, June timeframe, and I was buying ConocoPhillips for $36 and $40. Right now, ConocoPhillips is $132 right now, and year to date it's up 79%. But what I saw back then was I saw that this was an equity that I felt that was tremendously undervalued, and so I thought this would be a good recommendation for people to go out and pick out, and I picked some up myself. And right now I'm seeing the same thing out of Amazon and Google, and to a smaller degree Microsoft. And what do I mean by FAANG being the new Exxon instead of the other way around? Well, here's what I mean by that. I think back in 2020, I felt like everything could go up, but it was more likely that the oil stocks are going to go up a lot higher than, say, some of these tech stocks. And I think the reverse is true right now. I think that if you look at ConocoPhillips, for example, and you think about it 5 years from now, how much more do you think it's going to be than $132? Do you think it might go up to 150? Do you think it might be at 115? Do you think it might be below 100? Don't really know in 5 years where ConocoPhillips is going. All I can say is that I believe that Amazon here at $90 in 5 years will look like a lot bigger bargain than ConocoPhillips will, say, in 5 years. The same could be said for Google here sitting at $86. If the year is 2027 and Alphabet is still $86 or anywhere near $86, I'm going to be very surprised, as I'm sure a lot of you would be as well. The same cannot be said for ConocoPhillips. And I'm not the only one that thinks this. If you look over here at the Morningstar report here on Amazon, they believe a fair value for it is $150. They break it down into 1-star and 5-star prices. The 1-star price is $232, so they think it could go over $232 in the next year, but a 5-star price would be $90, which is where it's currently sitting at. Another company to look at, like I said, was going to be Google. If you look at this, the Morningstar says their fair value is $160. Just like Amazon, they have 5-star and 1-star prices. The 5-star price is $96. It's currently sitting at $86. This is a significantly undervalued stock and one that they believe could get as high as $248. I believe that to be true. Now, another one we could throw into the mix would be Microsoft here. Right now it's sitting at $221. They have a fair value estimate of $320. So it's got some upside, though not quite as much, I don't believe, as Amazon and Google do at this time, but it's a safer bet at the moment than either of those companies. It's got a 1-star price of $432, so they think conceivably this stock could actually charge clip to $430, and it's got a 5-star price of $224. It's currently sitting at $221. So all three of these stocks seem to be very good deals, and I think it's funny that they're kind of sending this stuff our way. We don't have to think that hard about what to invest in at the moment, as far as companies are concerned that we believe are going to be way higher price than they are right now. And even among NASDAQ stocks, they seem to be taking a little bit of a beating. If you look at the NASDAQ composite, last week it had a rotten week. It was down 4.48%. However, if you compare the NASDAQ at large, say, to Microsoft, you can see that Microsoft was down 5.35%, while the whole NASDAQ was down 4.49%. If we throw in Amazon here, we can see that Amazon was actually down 12% when the NASDAQ was only down 4.5%. And we could see that Google here was down 9.43%, or more than double that of the NASDAQ. So these companies, especially Amazon and Alphabet, are getting hit particularly hard. For this reason, what I'm doing now is a strategy in my portfolios. I'm just kind of selling puts on these equities, because honestly, I don't mind if I get assigned. As a matter of fact, please assign me. I'll take this. I'll take Google for $81. I will take Amazon for $86. I'll take Microsoft for $207.50. So what this says is that, let's say by the 11th of November, Google is below $81 a share. I'll get 100 shares of Google at less than $81 a piece. Someone has paid me $128.69 to keep this bet for them. So if it does go below $81 and I do get saddled with the shares, I'm going to be all right with that. I'm not going to be upset. The same could be said with Amazon. If I'm going to get Amazon for, say, $83 a share, I'm happy to do it. But if they finish above $86 a share, I'll get to keep someone's $210, and I won't have to buy Amazon. However, I'll sell the put again until eventually I am assigned, and I'm going to make sure that I'm assigned at a nice low number, similar with Microsoft. So right now I'm selling puts on these three equities, and I'm just kind of staying the course, and I'm waiting for the inflation data and the midterm results to come out and kind of hopefully provide a spark for this market. We don't know, maybe it won't, but hopefully it does. All right, yeah, so if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye.